All right, we are now live. I will give everybody just a couple of minutes to come in, and then we will get started in about 1 minute. All right, everybody, good afternoon, and thank you so much for joining us today. We know that the headlines can create a lot of uncertainty about what's going on today in the world, whether it's the markets, the economy, or global events, and it's very natural to feel uneasy. But uncertainty has always been a part of investing, and what matters most right now is having a clear and disciplined plan in place. So at KMH Financial Services, alongside our friends at John Hancock, who we'll be introducing in just a moment, our focus here is to help you cut through the noise and stay grounded in your long-term strategy. If you don't know Kim already, Kim, go ahead and introduce yourself.
Hello, Kim Herman. If we haven't met, we hopefully will meet someday. And if you have any questions and you don't want to, ask them online here, just feel free to email Kara or I any questions that you might have. As Kara mentioned, we understand these are interesting times, and Danny's is great. We've been working with Danny for 20 some years, so we've been at this a while with him, and he's done a lot of seminars for us and such. So you're in great hands, and he's going to go over the market intelligence. So thank you for participating and spending your Friday noon with us.
Hey, okay. Danny, yeah, thank you. Appreciate it. Thank you for the nice introduction. Thank you, everybody, for being here today. Appreciate you taking some time on Friday over lunch hour to be with us. So I know you want to hear a lot about the market. I'm sure you've been turning on CNBC or reading articles or reading Bloomberg, and you're probably a little concerned or maybe thinking about maybe I should be looking closer in my portfolio. So today I'll talk to you a little bit about market intelligence. I've worked with John Hancock, Manulife John Hancock Investments now for the last 23 years. I'm here local in the Mid-Atlantic, and I work with financial advisors, in essence, a consultant, and I help financial advisors with Medicare and Social Security, and more often than not, talking to them about where to put client assets in the equity and fixed income markets. So today we're going to talk about the market. So John Hancock puts out a book called Market Intelligence. You're looking at it here on the slide. And what it is it's an opinion book. What we're doing here is we're gathering the opinions of all of the asset managers we work with, people like, or firms like T. Rowe Price, or JP Morgan, firms like Raymond James or LPL or Merrill Lynch, a combination of asset managers and what they call broker dealers, gathering those opinions on the U.S. equity market, international equity markets, and fixed income markets, meaning the bond market, gathering those opinions and disseminating it out in a book called Market Intelligence once a quarter to financial advisors. It is client approved, so you are obviously allowed to see it and allowed to receive it. And what you're looking at here is that section on U.S. equity. You'll see a lot of colors here on the right. To give you a sense of how to read this, what you see in the darkest navy box up here where it says U.S. equity, bearish, neutral, and bullish, what they're trying to tell you here is the majority of those opinions that we receive are in the bullish camp on U.S. equities. And we receive about 85 plus opinions today between the broker dealers and the asset managers. So what you see here in darkest navy is the consensus opinion, but you will see lighter blue thoughts, and that's just telling you that some people are in that camp. Where you see the lightest blue is where you see the least amount of opinions. The orange diamond that you see is the one opinion of John Hancock Investments. That's our opinion. The group, as I mentioned, is over 85 opinions. So you see in large cap, we're neutral as a group, but also as John Hancock. You'll see the mid cap area and small cap area. The group is bullish, and these are areas that we like. And I'll explain to you why here as we go along. But just to kind of give you a sense, you've had a great 3 years of large cap performance. Obviously, companies in the Mag 7, the Apple, the Microsoft, the NVIDIAs, the Googles, Teslas of the world have done quite well the last 3 years. And this year has been a little bit of a struggle. I'll talk about that, but giving you a sense of what are the reasons why we would be wanting to be thinking about mid and small. Part of that is because you get a lot of mid caps. In mid caps, you get a lot of industrial companies and you get a lot of financials. You'll see at the bottom, we have more of a bullish opinion in U.S. value and a bearish opinion in U.S. growth. When we're talking about U.S. growth, we're talking about technology and companies like that are in the Mag 7 that I just mentioned. When you think of a large cap value fund, or I should say large cap stock on the value side, think of things like JP Morgan as an example, or something like Berkshire Hathaway, which is Warren Buffett's company. Those are typically considered value companies, and companies that pay dividends more often than that tend to be value companies. Okay, so you might be concerned just a little, right? We're in the middle of a conflict right here with Iran, and obviously the price of oil has spiked well over 100 worldwide on Brent, and we're at 100 on WTI. WTI is the domestic oil prices, and then Brent crude oil that you see listed at 110 right now is more of a global indicator of what oil costs. But you may be thinking, hey, okay, I'm very concerned. We have a lot of debt here in the United States. Obviously, the Iran conflict and some of the jobless claim numbers are a concern to the market, which has put pressure on it. But I wouldn't be as worried maybe in looking at the headlines. Really what you want to see as far as understanding indicators that we're really in a contraction mode is the slide that you see in front of you here. There's 3 indicators really that we use that would be cause for concern as to whether we were going into a major slowdown or a recession. And the first one, what you see on the right, is the initial jobless claims number. When you see that initial jobless number come in over 300,000, then that's cause for concern. As of the last one, March 14th, you would have seen it come in at 205,000. So well below where the alarming number would be. So that's one thing to tell you, okay, things are not as bad as you may think, even though the unemployment number has gone up. Remember, a lot of the jobs that were created, at least 50% of them, have come from the healthcare sector. There was a strike in the month of February, so that's why the job numbers were very soft. And of course, AI concerns are putting some pressure on that, at least social media wise. We're hearing a few companies are laying off, but what's the extent of that? We don't know just yet, right? The second indicator is more the one that I personally follow and a lot of firms follow on the institutional side, which is the high yield spread over treasuries. And you see if the high yield spread over 5%, that would be a concern. So currently the spread of a high yield bond over a treasury is 3.15% as of this Monday. When you think of a high yield company, think of something like Caesars Entertainment out of Las Vegas, or if I called you during the height of the pandemic and said, hey, listen, I'm going to issue a bond from Carnival Cruise Lines, are you interested? You'd probably be a little bit concerned because nobody's traveling on cruises during the height of the pandemic, right? So when we think of high yield bonds, think of companies that have some attached risk to them. So when it goes over 5%, which it went to about 10% in the height of COVID, that's when you get concerned. We're nowhere near that number, and that's telling you that if institutions are not worried about credit cracks, that's not a reason to be concerned about selling out of your portfolio. So that's a big indicator for people. And the spread on high yield over treasuries is hung anywhere from about 2.6 to 453 over the last couple of years. The low point last year, or I should say the high point, was 453. Like I said, we're sitting at 3.15, and that's pretty steady, hanging in the range of about 2.6 now to 3.15. So that's a big indicator as to not be worried. And then you see the unemployment rate of 5% or more at the bottom. We're currently sitting at 4.4. We've hung around 4.2 to 4.4 areas. So even though you're reading a lot about that on the news, that's not necessarily what's going on under the hood. Companies might not necessarily be laying off, but they're also not hiring, right? Because they have enough employees on staff. So how AI plays into that, that's obviously a concern to many. But what that looks like yet, we don't just know yet. So those are 3 indicators to tell you that, okay, things are still okay. Companies are still making plenty of money. these are three indicators that you want to keep in mind as we go forward. So if we move along to just the earnings growth estimates, the earnings growth estimates on the right are actually pretty good for the US. You can see here what the 2025, and obviously leading the way would be IT. You see here in 2026, it's 28%, which you might be thinking, okay, well, why aren't the Mag 7 doing better, right? If you own something with Mag 7 and the Mag 7s are down about, close to 13% as a group. And then if you own, a large cap growth fund, which includes these, you just look at the S&P 500, it's down about 6% year to date. That has heavy mags in it. NVIDIA, I believe, is about 6% of it. So it's not these companies are not making money. Their earnings are great, but you've had 3 years of great performance. And now you need to be thinking about who is the recipient of that AI technology. So the equal weighted S&P, which is basically 0.2% in 500 stocks, that's actually held up very well. That's flat to slightly down for the year. And since last September has done better, really even almost over the last year than the S&P. So the equal weight is another way to kind of look at the market and say, okay, the economy and stocks might do well, just maybe not technology. Maybe this is a year where it takes a break, but that doesn't mean you want to sell it. So through this Iran conflict, you will probably have noticed that technology is actually held up better than industrials and financials, as an example. But prior to this Iran conflict, financials and industrials have been doing very, very well. So this is just something to look at. And you'll see here when you're thinking about energy, energy has done quite well, but a lot of that is obviously driven by the fact that we're in this conflict, and that has pushed oil prices to spike up. Anytime you're going to get over 100 on oil, it's going to cause that concern of inflation, which is the reason why you've seen the 10-year Treasury note go up to about 4.39. And you get this talk about inflation, higher energy prices, right? Meaning more to pay at the pump, more to heat your home. And it's really a chain link effect. When you look at the areas that we actually like, and this was prior to the conflict because this was the first part of the year, but it really hasn't changed. The green dots will show you areas that we like. Obviously, technology here is one of them. You'll see industrials here. You'll see communication services, which is something like Google, and utilities. Why do we like industrials and utilities and infrastructure? Because if you think of really the focus in the last 3 years, 4 years, really since we've gone through COVID, every continent, every country, every city, every state, every county is really now focused building within and onshoring, especially here in the United States. So as we bring factories back here, you open up a factory, think about the fact that you need nuts, bolts, tires, screws. These are not necessarily only large cap companies, right? A lot of these things are in the mid cap space and in the small cap space, because about 18% of the mid cap index is in industrials. So it's a big part of large cap value funds, mid cap value funds, and small cap value funds. You will see industrials in there. So as we build out this AI database infrastructure, you need utilities, right? Who's going to power all this database? And of course, all the infrastructure that's associated with it. So those are areas that benefit from that. If you think about what I was talking about in the large cap space here, what some of the issues are and why are you doing better in other areas, you've seen this broadening out trade because you see here 41% of the top 10 companies in the S&P. That's a lot of concentration, right? You'll see here on the right, the PE at the beginning of the year was about 26.5, 27 times earnings. In the top 10, the mags were about 29 times earnings at the beginning of the year. Normally, it's in the range you see here for large cap in the S&P is about 18 times earnings, just below that. So we're well above that. And the last 3 years have been very, very good for the stock market. So this is a year where you've seen inflection even prior to the Iran war, where people said, okay, I own a lot of this large cap stuff, but I want to be thinking about other areas. International is one of them, emerging markets, which is part of that. And of course, small, mid, and even the dividend paying stocks have done well this year. It's just more of a broadening out trade. And that has a lot to do with valuation and the dollar, which I'll talk to you about here in a few moments. So as you just look at some of the areas, and this is a busy slide, to the left, you'll see the S&P 500, the emerging market index. You'll see the European, Asia, Far East index, and then in the right here, the mid cap and the small. So how you read this is the blue dot shows you the current PE at the beginning of the year, 22 times earnings on the S&P, and then the average being here, you see about 16 to 17. I said 18 on the last slide, but it's usually around 16 and a half to 17. And then you'll see emerging markets, the current slide here, and then the MCI, EFA, and then the mid cap you see here. So the biggest discount comes in small caps. And remember, small caps are very reliant on regional banks because there's a heavy weighting there to financials in the small cap value index. So that's important when you start thinking about, okay, if you think small banks are going to do well, then that's probably when small caps will do well. Also remember, a lot of the times, especially in the Russell 2000, 40% of the companies in the Russell 2000, which is a small cap index, are actually not profitable. So that's why it's volatile, and why people tend to stick with large caps, just from the standpoint that these are well-established companies. But this gives you a sense of why you start to see some performance here. So just to give you a sense, prior to the conflict, mid cap was up about 9.5%, and small cap was up about 8.5%, 9%. So we were seeing some good performance, and I think we'll see it again if and when we can settle this out. Okay, so let's talk about international. You'll see the opinion of the group. We have a neutral weighting in international, European equity. We're bearish specifically at John Hancock, but you'll see a bullish opinion in Japanese equity and in emerging markets. So what's driving that thought? Well, the first thing we look at is manufacturing and improving numbers. So you'll see this slide here. Anytime you see these PMI data numbers, which stands for Purchasing Managers Index numbers, anytime it's over 50, you can see on the right, it's a little small, but France, UK, China are just over 50, you see, and then Japan's just knocking on the door, which is part of the reason why we like it. But you'll notice on the left, if you're below 50, then you're in the contractionary mode. If you're above 50 on the left here, the arrow points up, which you're in expansionary. So this is a good sign. Are we saying, hey, that Europe is going to do better than the US? Probably not in earnings, but if you look at valuations are a lot more attractive overseas. A lot of people feel the dollar will weaken over the next 3 years. And that'll kind of give you a thought into the next slide, and I'll talk about the dollar here. So this, I really like this slide. What you'll see on the left here, if you go back to 1980, basically, you'll notice in the gray here, as the dollar increases, that's very good for the S&P and US performance, not as good for foreign performance, foreign equity performance. But when the dollar declines, and you'll see it here from about 1985 to 1993, when the dollar declines, it's very good for international performance and not as good for US performance. If you slide your eyes right, since basically 2008, the US dollar has been in an appreciating environment. So that's been very good for US stocks, not as good for international. But last year, the dollar DXY, which is what you're looking at here, was down 9.5%. So you had foreign large growth funds up about 30% last year. You had foreign large value, which has a lot of financials and industrials in it, up about 40%. So these were areas that had not done all that well compared to the US the last 10 years. But it reminds us, okay, why do we asset allocate? Because diversification obviously limits some of the downside, but it also helps you on the upside. Now, the dollar is strengthened here about 1.6% year to date as of today, and that's because of what we see going on with the Iran conflict. You've seen oil spike, and as oil spiked, the dollar has strengthened, and gold and precious metals have actually done poorly here through this time frame. You did very, very well owning precious metals and owning gold the last year and a half, because that's been somewhat of a hedge to the dollar. As the dollar has weakened, gold has done extremely well, but as the dollar has strengthened, gold has declined. So you think about the impact of the dollar, really that is fueling thumb as far as President Trump's comments on one of the reasons why he wants to lower rates. Yes, lowering rates will stimulate the housing market, the auto loan market, and a lot of other businesses and industries, of course. But I'm originally from Canada, originally from Montreal, which is like another planet to some people here in the Mid-Atlantic. But you'll notice all the baseball memorabilia behind me. I'm probably one of the only baseball fans because it seems like everybody in Montreal is a Montreal Canadiens fan. I am too, but I'm the last remaining Montreal Expos fan that exists. And for those of you who follow baseball, you know that the Montreal Expos moved here to DC. They're now the Washington Nationals. But the reason why I'm telling you that is because if you want to fix a trade imbalance, if you're an economist or you've taken an economics class, there's a couple ways to do it. Whether you agree with it or not is another story. But one way is to employ tariffs, which we've done, obviously. But the second way is to lower your interest rates. If you lower your interest rates, what ends up happening is money goes overseas to find more attractive and higher coupons, but also to find more attractive, maybe valuations on the equity side. So last year was a really good example of that. But what that does, when you lower your interest rates here in the United States, it depreciates your dollar and appreciates the other dollar of the other country. So just to give you an example, I mentioned that from Montreal. I went to Montreal last April, and the dollar was $1.43, meaning every U.S. dollar was worth $1.43 Canadian a year ago. As of today, the American dollar to the Canadian dollar is $1.37. So it's dropped about 6 cents in a year, and that helps the Canadians actually be a little bit more attractive as far as them wanting to buy from us. Remember, when you have a strong dollar as we do, it's not good for Canadians or other countries to import from us. They don't want to buy that much from us. In our case, most of these countries are exporting to us. So from Canada, we buy, just from a natural resource standpoint, we buy oil, lumber, steel, and aluminum because it's cheaper for us, right? So they're doing a lot of exporting to us, but they're not buying a lot of things from us. And that's why you saw last April 2nd, why President Trump right off the bat put tariffs pretty much on every country, because they all have the weak dollar for the most part, and we have the strong dollar. Not so much, obviously, in the UK and with the euro, but the first countries that he basically picked on were Canada and Mexico, and that's because they had the weak dollar. All right, that was a mouthful for all of you. I apologize if I sounded like I was spitting water from a fire hose, but I think it's a very important topic because that's really what's ruling thumb as far as a global economy and interest rates. We're never going to come out and say we're manipulating currency by lowering our rates. But President Trump was asked 6 Tuesdays ago when the dollar fell, are you concerned? And he said, no, not at all. Actually, it's not a bad thing. So improving that trade imbalance is obviously important. All right, so let's move on from there. Let's talk a little fixed income. And you'll see in the bond market, you'll see we have a neutral weighting. John Hancock is bullish. You'll see we like the mortgage-backed securities, which is like Fannies and Ginnies. And you'll see we like municipal bonds. Everybody always likes tax-free bonds because when you're affluent, or you're always going to buy tax-free bonds because you're looking for a way not to pay taxes, right? Munis didn't necessarily have a great first quarter last year. There was an oversupply issue in March, and then they came back nicely, and most of it finished up over 5%. So on a tax equivalent yield, you did quite well. But when you look at the math, the CPI number is really what rules thumb. So as oil spikes, I mentioned to you, inflation is a concern, and the Fed is trying to do everything they can, obviously, to fight that, which is part of the reason why we have not lowered rates here. But you'll see shelter is 35% of it, right? And you see home prices have been declining. You all know that more often than not now, unless you're looking for a second property and you have enough money in your bank account to buy a second property for cash, you're great. But if it's your first property, you're probably not moving because you're going from a 3 to 3.5, maybe even 4% 30-year mortgage to what? A 6.5, 7% type of mortgage. You're not going to move. So until rates come down, you're probably not going to see massive movement there, but we have seen home prices come down. And of course, rents have come down a little bit as well. Okay, so you'll see recent indicators point to a weakening U.S. labor market. So the whole comment about the jobs numbers slowing, this is an issue. The obvious concern is just understanding how much does AI have an impact on it. And I think when you talk to somebody who works in that particular field, you get a better sense. If you turn on the news, they're telling you, 40, 50% of people are going to lose their jobs. Is that really the number? We don't know. But this is part of what's kind of pushing some of those job numbers to come down as companies are kind of tightening the belt. All right. Lastly, as you look here, well, not lastly, but one of the last slides here in fixed income, you'll notice yield. So what I want you to pay attention to is the MBS, which stands for mortgage-backed securities. You're looking at yields of about 4.63 taxable. And then investment-grade corporate bonds, which is a popular investment for clients and retirees, is at 4.82. So this is an area that we like, especially for safety. So if you start thinking about the bond market and you want to understand, okay, when do I know if I'm going to make money in bonds, or I'm going to be flat in bonds and just collect the coupon, or I'm going to lose money in bonds? This is kind of a good indicator. So what you're looking at on this slide, it's a little mathy, but you'll see at the beginning of the year, the 10-year Treasury note was at 4.17. We were around 4.35 when I looked at it this morning. So let's just take it at 4.17. And for those of you who are wondering about this, you can see this number if you watch CNBC or you turn on Bloomberg. They flash it up at the top, or you go on the CNBC website. The number's there when you click on bonds. This is a really good indicator to kind of understand what the market's doing, because the bond market really rules thumb over the equity markets. So what you're looking at below is a scale that shows you movement to different numbers in the 10-year Treasury note. And then what it shows you below that in the colors is what your 12-month total return would look like, meaning what would you get from the coupon plus maybe some appreciation or depreciation in the price of those bonds. So let's assume, which is kind of what happened here recently, you went from 4.17. Last year, we went to 4.5. That would mean, okay, oil spikes well over 100. I told you we went to 439. What does that look like going from 4.17 to 450 over a 12-month time frame? You would end up with a total return of 2.36. So you'd be losing a little bit of your principal, but your coupon would come back to you. So you'd still be a positive return. But let's assume the economy slows a little bit, but we settle the Iran conflict, oil prices come down to $60, $70, and we go to 4%, which is kind of what I think you're probably going to see when we settle this out, if and when. If we go to 4, you end up with a total return of 5.31, which is really what bonds are supposed to do, right? Clip coupon. If you go from 4.17 to 3.5, your total return would be 8.27, which is a really good return. What would cause that? Maybe some concern over the economy slows, or let's just say that the Fed decides to lower rates, which you probably will see at some point. We're probably going to see a new Fed chair here in June. It'll probably be Warsh after they turn him upside down and shake the change out of his pocket. Congress will probably approve him. And then we'll probably see 2 lowering of interest rates this year, assuming we can get through. They won't do it, obviously, through the Iran conflict. I know there's conversations about raising rates, but not so sure you're going to see raising of rates. It's more stand pat. Because they do want to lower rates, and you heard the reasons why earlier from me. All right, lastly, so just in summary of this, we're very big on buying high-quality companies at a reasonable price. You're seeing a lot of that this year. If you follow any of the dividend-paying type of investments, you'll notice that a lot of these investments are doing well this year. Consumer staples have done well when there's uncertainty, even though they had not done well the last few years. Really, tech stocks were fueling it. You heard my comments early on mid-cap stocks. We like the mid-cap area because you do get good exposure to industrial. So if you believe in the infrastructure and onshoring story back to the United States, we believe that should be part of the portfolio. Non-U.S. equities was a good year up until recently, obviously, on emerging markets and international. Falling dollar definitely contributes to performance on international equities. You'll see high quality for fixed income. We like it more so as a non-correlated asset class, even though you're not seeing that right now. We do like fixed income, and you will make good money in bonds if we do come down from the 10-year yield now in the 430s range down to 4. Not only will you collect coupon, but you would make some money on the pricing of those bonds. Not that I'm necessarily saying that's right for your portfolio, but that would be a scenario where bonds would do well. And you heard my comments about infrastructure. Long short is more of alternatives. You are looking, you're seeing people do a lot more things around alternatives. You can't really turn on a TV right now without them talking about the concerns in private credit. That is something different and unique. I won't touch on that today, but that just kind of gives you a sense of the things that we like. So I'll stop there. I'm basically on my 30 minutes. I'll turn it back over to Kara and Kim, and I'll thank you all for being so attentive. If you have some questions, feel free to put them in the chat, I believe. But Kara, take it away.
Yeah, so you should have at the bottom of your screen a little Q&A box where you can drop questions if you have any. We do have a couple of questions that have come through to me. So Danny, the first one we have is what happens if this conflict with Iran goes long term?
So that is definitely an issue. No two ways about it, because the market does not like surprises, right? The market wants to know what's going on well ahead of when it really happens. And that's not really what we were told by President Trump as far as the length of time, right? So the Strait of Hormuz, I walked into a restaurant, I think I called it hummus one time. So I thought we were talking about Greek dip for a moment. And then I was like, okay, no, we got to read a little bit. You've got to read a little with more detail. So if they can reopen the strait, and that's really what is a big problem, because 20% of the oil that flows through to the world really goes through that strait, right? So if that's closed off to us for a long time and that keeps oil at a much higher price, that is going to cause more disruption, and it's definitely going to weigh on your portfolios, and it's going to weigh on the economy. No two ways about it. I think if you get off this call today and you turn on any of the news outlets, you will hear a lot about the fact, okay, companies are doing this and that based on where oil prices are. Look, I think you don't want to be as concerned, because if something can be fixed with a stroke of a pen or a social media tweet, you want to keep your mindset to stick to your plan, because that could change on a dime, right? And you saw that last year, April 2nd, when the tariffs were employed. And then it wasn't even 10 days later where President Trump was pulling back on the tariffs and the market recovered very quickly. So length of time will definitely weigh on a portfolio. No two ways about it.
Okay, so then there was a follow-up question to that. Can you explain the relationship between the oil concerns and the dollar?
Yeah, I talked a little bit about that a little bit earlier, but I'm happy to go back to it, because that's really what's driving the underperformance, especially in international. So I mentioned to you, the dollar has spiked, right? And because the dollar has spiked, that has been a direct correlation to the underperformance in emerging markets and international. Obviously, the entire market, but more so there. You'll notice on days where we've had a good day, you get very, very good performance in international equities, almost double of what you get in the US. And that's because the dollar weakens, you get good performance on international. So the dollar really is the key, right? So if oil stays elevated, it'll put pressure on your portfolio, because the dollar will strengthen. And because of that, gold will sell off, and other investments that people have really seen as probably where you want to be investing over the next couple of years. So this is kind of a weird market from the standpoint that the dollar has really given you an indicator that if it weakens, you'll do well with international equities. If it strengthens, normally you would do better with U.S. equities, but that's not the case, and that's because we have this Iran conflict, which is putting pressure on pretty much every sector.
Okay.
I gave you a long-winded answer there, but that was a good question.
With the next one we have is based on one of your sector slides closer to the beginning. Do you see energy having lots of room to grow?
Well, I think, look, if you're thinking to yourself, hey, you know what, I wanted to go buy an ETF in the energy sector because I think I can make a lot of money. You've already done that maybe in the last month, kind of thing. If you were going to do that, do I suggest it? No, and I'm not here to give you advice. Obviously, you'd have to talk to Kara and Kim. But my concern with that is that if President Trump settles out a deal here in the next few days, or says, hey, listen, we've done what we needed to do in Iran, we're leaving, what's going to happen to energy prices? They're going to drop, right? You're going to go from 110 on Brent crude probably down at, $60, $70, fast. And then you would lose money in energy. So it's really more about having a balance in the portfolio, when you get these short-term spikes, that's more of what a trader would do, not what an investor who has a long-term approach.
All right. Perfect. Kim, do you want to add anything to that?
Well, I think you explained the whole energy issue. I mean, commodities like gold, we've seen, even though it's been a nice run, commodities are
Yeah.
highly volatile. So, and not only that, in various exchange traded funds and mutual funds, you have a various companies and gold companies and, oil companies in them anyway. So it's better to be diversified than trying to, to pick the spot you're going to buy. When this is so unpredictable that if you had bought it one time last week, that a couple of days later you would have lost 20%. So, and now it's back up again. So I think like Danny said, commodities are just you would just want to make sure you got your running shoes on if you want to be a trader. So
Okay. And then the last question, what are analysts currently seeing as potential end of year outlooks?
Well, everybody had a pretty good outlook coming into the year. They just were kind of backing off of technology because you had, you know, three very, very good years, which is unrealistic really to get those kind of returns. So everybody changed their focus, it seemed at the beginning of the year to say, okay, who's the recipient of the AI? So you had things like McDonald's, Walmart doing well, dividend paying stocks. People were more focused on industrials like something like Caterpillar. So you had, a change in the guard in essence. That doesn't mean people don't want to own technology stocks, but maybe they were not putting the next dollar there. They were just reallocating as far as that's concerned. So companies are making money. The issue this year really has more been about software. You had this issue last year where software did not do well. And into this year, it was probably the first week of February, if I have my dates right, where you had, the conversation around AI replacing the software. So Microsoft now is down 20%. Adobe, Salesforce, Workday have not done well. They didn't do all that well last year. And then you had this kind of issue, which is part of the reason why you have this issue in private credit, because private credit, they own a lot of software. And that has put pressure on a lot of the indices because Microsoft is a big part of the S&P 500, large cap growth funds. It's even in dividend paying funds because Microsoft pays a dividend. Now, is that a company people don't want to buy anymore? No, of course, it's a great company. But when you have these overhanging issues, that obviously hurts the indices. But nobody was walking around saying, okay, you know what, we need to get out of the market. If companies have cash on hand, remember, you can afford to pay your dividend payment. You can afford to do research. You can afford to hire people if you want to. So we're not in that environment where companies don't have cash. They're healthy. Certain sectors are an issue, no two ways about it. And look, food prices are probably never going down. I'm sure many of you expected that your restaurant bill would come down after COVID, and it really hasn't. And if you go to the grocery store, we all know that if you're a family of two, four, six, you're leaving with a $300 bill and, maybe you're left with some eggs and, some Doritos and Ruffles and milk. So that's always going to be an issue. I think when you separate, I'm giving you a long-winded answer here, but I think this is important. When you separate the 5 quintiles of income brackets out, and I heard this from a portfolio manager last year, and I think it holds thumb to be thinking about it. He said the bottom 20% of that income 5 quintile bracket only account for 8% of the retail sales. So I would be more worried if the airports were not packed. I mean, unfortunately, people are waiting in lines, right? But that means people are traveling for vacations at Easter. They're traveling for work. And I think many of you who've tried to travel to some island on vacation, you can't get on a flight for almost less than $1,000 and you can't stay in a hotel for less than 500 a night. When you start to see those numbers come down, then I would be more worried about what's going on in the economy, because that's the group that really the top 40% there is really driving the economy. And I think it's always been that way, but you'll turn on the news and they'll tell you that, people can't afford to buy groceries or what have you. And that's true. And it's not a good thing, obviously. But they're not the ones that are driving the economy as to whether the equity markets would do well or not.
All right. Thank you, Danny. That was very insightful. Kim, anything else to add on that one?
Well, I think in the conversations, we've in our various meetings we've been having the last, couple weeks, month, is that, in the beginning of the year, even though, the Mag 7, was doing it the last couple of years, if you say the technology sector had done quite well, the thing is that when the markets run straight up like they have, we are expecting pullbacks. So we weren't expecting a war, but we were expecting pullbacks. So to some kind, otherwise, remember Greenspan talking about irrational exuberance, So we do have to have, it has to shift, and maybe it shifts from growth to value or whatever. But can you comment on that? Because I think we've had a lot of conversations on that.
You're talking about on shifting from growth to value?
Yeah, no, just from the fact that, we were expecting pullbacks because of the straight up movement in the markets the last couple of years. The markets have to correct itself, it can't just continue to go straight up. So even, not factoring in a war, but the war obviously, brought that a lot quicker. But there were some expectation that we would have some shifts in the market.
Yeah, well, you've had much more attractive valuations in other categories, right? So the technology growth rates have just been so great, and the earnings have been so good, from companies like Nvidia as an example, that it was hard for people to ignore. Right now that you've had this kind of return and you've seen the dollar weaken, now people have paid attention to, okay, what did well last year outside of the Mag 7, right? You were well rewarded for owning international stocks. You have some firms that are talking about the amount of debt that we have in the US and valuations. So you've gotten money to move overseas. And as I mentioned to you earlier, if you think about growth versus value, you really have a lot of people believing in this AI database build out. And that's why things like infrastructure, utilities, areas that are more value driven are doing very well. Financials had a great year last year. So that's why a lot of large cap value funds or international value has done well. And foreign financials are cheaper than they are in the US. So that's another attractive valuation opportunity for people. And remember, UK, Europe, and Japan are more and more noted for brick and mortar. They're more the value categories as far as healthcare, industrials, and financials. People look to information technology, IT, and emerging market countries, places like Taiwan, Korea, India, those countries, and China, of course, are where you typically get the emerging market plays, and it's usually technology. So if you look at Taiwan Semiconductor is a huge position. It announced really good earnings in January, and it's really been a big driving force in performance up until the Iran conflict. So those are things that are in other indices and things that people would want to be looking at if they were diversifying out. Now, whether that's appropriate for your portfolio, I don't know. So don't call Kim and Kara after this call and said, hey, he was talking about Taiwan Semiconductor and it's a great stock, we should buy it. So not necessarily recommending the stock, but I'm giving you a sense of where money movement has gone and why. And China, Korea, Taiwan, and India have been areas that people have been looking at as far as growth opportunities.
All right. Well, thank you very much. There is one more question that just popped in.
Sure.
Are the BRIC countries a concern with regard to moving away from reliance on the dollar?
Oof. I don't know if I have an educated, proper answer for you on that one. I think I might have to put that one on the shelf. I can tell you that when they tell you that we're not the reserve currency, I think that's news fodder. I don't think that will always be the reserve currency. There's just so many people and countries that own our treasury. So it's hard to say we're not, the currency that people will be looking at. So I think that's important to understand. I think, can we manipulate currency now to make trade imbalances between countries? Listen, they're not going to say that. People have labeled China as a currency manipulator over the years, but the dollar is the major game right now. I think it's the biggest thing that everybody's focused on because you can't trade if you have a strong dollar as much as you can if you have a weak dollar. So I think that's important to watch going forward.
Right.
I didn't really answer that question, so I apologize. But like I said, I don't know if I'm as well versed on that specifically to give you a good answer.
All right. Perfect. Okay, so it is actually, that's time for us, and I want to make sure everybody gets a chance to wrap up their lunch and head back to work or to wherever you are going this afternoon. Thank you so much for joining us. If you have any additional questions, feel free to email us or give us a call. We'd be happy to answer any additional questions you have. And thank you, Danny, so much for joining us. Always a pleasure.
My pleasure. Thank you, everyone. Have a great weekend.
Thanks everybody for joining.
Bye, guys.